Welcome to Signals and Noise, the podcast where we decode the data behind the world's biggest decisions. Today's topic: can we see the future of currency markets by looking at charts the way a computer sees images? Our guest is Dr. Karacor. His research explores using visual features from price graphs to predict short-term moves in Forex. Dr. Karacor, welcome.
Thanks for having me.
Your paper's title sounds technical: Exploiting Visual Features in Financial Times Series. Give us the movie trailer version. What did you do?
I'm excited to talk about this. In plain terms, we treated price charts like pictures. Instead of feeding a model only raw numbers, we extracted visual clues, things like where recent prices have clustered and the relative heights of peaks and depths of troughs, and used those clues to predict whether a currency pair is more likely to move up or down in the next few hours.
So rather than traditional indicators, you built what you call finance vision, almost like computer vision for markets?
Exactly. When people look at a chart, they intuit patterns. Price keeps revisiting this zone, or lows are getting shallower. We encoded that intuition as measurable features. One key idea is density. If you imagine stacking tiny dots at every open, high, low, and close, some price bands become crowded. That crowding often carries information about near-term behavior.
Give us a concrete picture. Suppose I'm staring at USD on an hourly chart. What does density look like?
Picture the last couple of weeks of hourly bars. Now split the price range into several bands. For each band, count how many OHLC points landed there. You end up with a small histogram that tells you where the market has been spending time. Combine that with recent highs and lows, normalized, so we're comparing apples to apples, and you get a compact visual fingerprint of the market's shape.
What did you train on, and how did you test it?
We used real, tradable hourly data from 4 currency pairs over many years, from the early 2000s through mid-2000s and teens, and framed the task as a 5-hour directional classification. Does the market reach an upside threshold without first hitting a downside threshold, or vice versa? We compared several popular models, neural networks, support vector machines, and XGBoost, all trained on the same features, so the comparison is fair.
And did the visual features actually help?
They did. Models that included density-based visual features consistently outperformed versions that excluded them, even when we replaced density with other commonly used features to keep the feature count equal. In other words, the where price spends time signal was genuinely useful.
Any results that surprised you?
Yes, the most traded pair, EUR-USD, was harder to predict than some less popular crosses. On the other hand, EUR-CAD came out relatively more predictable in our setup. Also, while support vector machines scored very well in sample, XGBoost trained dramatically faster, which matters when you want to refresh models frequently.
Let's bring this down to earth. Say I'm a curious listener, not a quant. How should I think about this in practice?
Think of it like weather nowcasting. We're not claiming to know the long-term climate. We're estimating the next 5 hours based on how the recent clouds and the dense price zones are arranged. It's an extra lens. No single lens is perfect, but combining lenses can sharpen the picture.
Could you walk us through a mini scenario?
Sure. Imagine USD JPY has built a dense band just below a recent high, and recent lows have been getting progressively higher. The visual fingerprint says, buyers are repeatedly accepting slightly higher prices, and the market keeps revisiting the upper band. In our framework, that pattern tilts the probability toward reaching the upside threshold first in the next few hours. It's not a guarantee, just a statistically informed lean.
And just to be clear, this isn't financial advice, right?
Right. It's research. A trading strategy needs more pieces: risk management, costs, slippage, and rules for when not to trade. Our study isolated the prediction component to see if the visual signal itself carries weight. The next step is to embed it into a full strategy and evaluate profitability, not just predictability.
What about limitations? Where does this approach struggle?
Markets change character. What worked in one period can weaken in another. We also saw performance drop when we validated on a later, out-of-sample year. That's a healthy reality check. It suggests we should retrain regularly and explore techniques that adapt to regime shifts. And because density summarizes recent behavior, shock events can still overwhelm it.
Looking ahead, what excites you most?
Two things. First, hybrid models that blend visual density with order book or volatility context. Second, transparency. Tree-based models let us inspect feature importance and explain decisions in human terms, which is vital if you want people to trust an AI-assisted signal.
Final thought for listeners who love the aha moments.
Don't be afraid to reframe a problem. Treating time series as images sounds odd at first, but it unlocks different information. If you're exploring data in finance or elsewhere, sometimes the new angle is the edge.
Beautifully said. Dr. Karacor, thanks for joining us and for helping us see markets a little differently.
My pleasure. Thanks for having me.